In its latest outlook, the International Monetary Fund says that the world economic recovery has split into 3 speeds. In Europe, growth is weak, but in the U.S., activity is picking up, while in emerging market and low-income countries, they are again growing strongly. Overall, growth in world output is forecast to reach 3.3% in 2013 and 4% the following year. That's little change from the last update in January.
I think the main challenge is still very much in Europe. The US is doing better, emerging markets are doing fairly well. Europe is still the issue. What you have is weak banks, weak governments, low growth, and there's always a danger when that things are there together, that they build on each other and that things go from bad to worse. That's the issue.
While global prospects have somewhat improved, new risks have arisen and old dangers remain. For the moment, advanced economies face a bumpy path to recovery. Although the euro area has taken strong actions to address the debt crisis, now that financial markets are bullish, there's less pressure on policymakers to continue the reforms. The IMF is calling on national governments to maintain the gains of the last year while doing everything they can to support their economies while demand is weak.
Europe should do everything it can to strengthen private demand. What this means is aggressive monetary policy, and what this means is getting the banking system, the financial system, to be stronger. It's still not in great shape. Manage fiscal consolidation so that it happens, but not so as to kill growth. And there are some structural reforms which will help.
Although the U.S. forecast has been marked down slightly, signs of growth are now strong enough that they have nearly overcome the drag on growth from the federal government's automatic spending cuts in the sequester.
So behind the U.S. recovery, I see 3 main forces. So the first one is very strong monetary policy, which makes the rates very low. The second is a banking system, which is not yet in perfect shape, but is much stronger than it used to be. And then the third is this thing that economists call pent-up demand.
The IMF says emerging and developing countries are driving the global economy's third and fastest speed. In Asia, growth has returned to a healthy pace with improving demand from advanced economies and government policies that are supporting growth in China and India. In Latin America, interest rate cuts and measures to boost private spending will help spur growth in Brazil.
The main challenge for them is to deal with what's happening in advanced countries. And what this means is fluctuations in trade, capital markets, very volatile, capital flows coming to them. They basically have to handle the capital flows, they have to maintain activity, avoid overheating.
The exception to this is the Middle East and North Africa, where slowing oil production and political transitions in some oil importing countries are taking a bite out of the region's growth. Overall, Blanchard says policymakers face a difficult balancing act in moving from stabilization to growth and can't yet afford to relax.
There are still many challenges and things can still go wrong. The recovery is just not assured.